Risk is part of everyday life. Whenever people are making choices about their careers or their businesses or their personal plans, they are making decisions without exactly knowing how things will turn out. Sometimes things develop as expected, sometimes they don't. But most of the times, when we take decisions, we don't even notice this uncertainty. When we accept a job offer, or start a project, or launch a new business idea, we don't know exactly what the outcome will be. So, what is risk? In very, very simple terms, risk is the uncertainty that we have when we make decisions because it can influence whether we will achieve what we're trying to achieve. Because unexpected events may affect the results we hope for. And when we start thinking about risk this way, we will realize that risk exists almost everywhere. So, yes, this idea affects our business and our personal life decisions. For example, someone may choose to invest their money, but there's uncertainty on how markets will move in the future. Or someone choosing a career path hoping that it will lead to future opportunities, but you never know how things will turn out. Or someone else may buy a house and have a mortgage hoping that their financial situation will remain the same. But things can change over time. So, yes, this idea affects our business and our personal life decisions. In other words, people are taking decisions while dealing with uncertainty. The same principle applies to businesses because companies make decisions all the time without knowing exactly how things will unfold. And here comes the idea of risk management, which is ensuring that the risk that you're taking is at an acceptable level. Now, risk management doesn't mean eliminating risk completely. Think about something simple. Someone wants to reach a destination and he has some options. First option is use a car or public transportation and go where he wants to go. Still, there's always a risk of an accident. If someone wants to completely avoid that risk, then he needs to stay at home and never go anywhere. But if they really want to reach their destination, most people will choose either to drive or use public transport to go where they want to go. And they may choose to manage the risk of an accident instead. For example, they may drive more carefully, reduce their speed, or follow safety rules. These are some risk mitigation measures. The same idea applies to businesses. In reality, you cannot do business without some level of risk because zero risk means zero business. Think about it. A company wants to expand into new markets, but they never know how customers will react. Another company may invest in a new product without knowing whether it will succeed. Or an organization may introduce a new technology that improves efficiency, but this new technology may create new operational challenges. So the point is simple. Many important decisions involve some kind of risk. The only way to avoid risk is to do nothing. But if you do nothing, this means no business. And if there is no business, then there is no profit. For this reason, organizations are not trying to eliminate risk completely. They are trying to take calculated risk and take effective measures to mitigate those risks to an acceptable level. Business leaders are trying to understand the risks they are taking. Some risks may be acceptable, some may need to be reduced, and some risks may be avoided altogether. All these are business decisions. Risk management helps organizations think ahead, consider what could go wrong, and be prepared for it. When this is done well, organizations can move forward with a cleaner view of the risks that they are facing, and that allows them to make better and informed decisions. So, yes, risk cannot be completely eliminated, but it can be managed. And in practice, organizations follow a few basic steps to do that. First, they identify the risks they are taking. In other words, they ask, what could go wrong? Second, they are trying to understand how serious these risks can be in case they become a reality. The question here is, how likely is it to happen? And if it does happen, what would the impact be? Third, organizations put control in place to ensure that these risks remain at an acceptable level. Example of control, some policies, some procedures, some monitoring systems, or internal checks. And the last one is they ensure that these controls they are actually working. This is important because risks do not stay the same. Markets change, technology changes, regulations change. Organizations are required to review their risks regularly and adjust their controls when necessary. That's why risk management is not something you do once and forget. It requires ongoing attention throughout the organization. Risk management is important for all types of organizations, but it is particularly important for financial institutions such as banks. Because banks, they hold customers' deposits, they are providing loans, and they overall move money across the financial system globally. Because of this important role, banks face specific types of risks, and when things go wrong in one bank, the consequences may be extensive because these consequences may not only affect the organization itself. If something goes wrong, customers may lose confidence, financial markets may react. And history has shown that problems in one bank often may create problems in other banks also and affect the wider economy. For this reason, banks and other financial institutions are not expected to manage risk as a matter of good practice. Regulators expect them to identify, monitor, and control the risks they are facing. Organizations face different types of risks. Some risks are related to their operations, some to their finances, some involve legal obligations, and some others involve reputation. Banks face some additional types of risks. These include risks such as market risk, credit risk, liquidity risk, and compliance risks. I will not go into more detail here because each one deserves its own explanation, but we will cover them in a future episode. Another type of risk that has received a lot of attention in the recent years is financial crime risks. And almost all organizations, almost all businesses are vulnerable to this type of risk. For example, some companies may face cybercrime risks, where someone may hack their systems and access their customer information or emails and trick employees in sending money in another account, in an account that the fraudsters control. Some other businesses face corruption risks, meaning a vendor may bribe the employee of a company so they can provide them with access to a specific contract or some business opportunities. Banks are particularly exposed to financial crime because this is where the real money is. But actors often try to use banks or payment institutions or crypto platforms or similar type of entities to move money, to move the proceeds of their criminal activities without getting noticed. Banks are required by law to take specific measures to prevent and detect financial crime. The question is, why should I care or why should you care? Because understanding risk matters for everyone, and especially in business. So, whether you are a business owner or you aspire to become one, a founder, a member of the board of directors, you are not expected to manage every single risk personally. And you don't need to know every technical detail. What matters is for you to understand that it's extremely important for your company to understand the risk it is facing and put the appropriate controls in place to keep them at an acceptable level. This comes down to asking a few simple questions. The first one, what risk does the organization face? The second one is, how do we reduce those risks to an acceptable level? And third, do we have the right controls in place to ensure that they remain at an acceptable level? And last but not least, how do we ensure that these controls actually work? These kind of questions help leaders understand whether risks are managed properly and whether the organization is prepared for potential problems. So before we finish, here is one key element I want you to remember. Risk is not something that exists only in bank or other types of financial institutions. It's part of personal decisions, business decisions, and part of how organizations operate on a daily basis. In fact, the majority of business failures are linked to poor risk management. The difference between organizations that succeed and those that struggle is not the absence of risk, it's how well those risks are understood and managed. So the next time you make an important decisions in business or in personal life, just pause for a while and ask yourself, what could go wrong and am I prepared for it? So what risks are you facing on a daily basis? Please comment below. Maybe I will make this the subject of a future conversation.